तो आज हम लोग इंडियन इकोनॉमी डिस्कस करेंगे। चलिए स्टार्ट करते हैं। इंडियन इकोनॉमी। इंडियन इकोनॉमी, this is very important topic of the GS, and there are number of questions has been asked from this topic. So we will cover this topic into following subtopics, namely we will first understand economy. When we talk about economy, that means general public understand that this is money. Okay, so we will understand money first. Understanding money. Understanding money. In this itself, we will understand following topics, namely monetary policy, and then related to that there is a curve known as yield curve. Then we will understand inflation and its relationship with unemployment, fiscal policy, then we will understand fixed and floating exchange rates, fixed and floating exchange rates. Then we will understand the relationship of exchange rate with international trade. International trade and inflation, the relationship between exchange rate and inflation as well. Then we will understand balance of payment. Balance of payment. And this in short we call it BOP. Then we will also understand BOP crisis. Then we will understand central banks, role of central banks. Okay, and two more topics, related topics, that is inflation versus growth, inflation versus growth, and money laundering. Money laundering. Right. After understanding money, we will move to understand another topic, that is Indian financial system. Indian financial system. Okay, and then we will talk about macroeconomics, and so let's what we will study in Indian financial system. Basically we will understand in this RBI money multiplier, concept of money multiplier, and inflation we have studied here, its relationship with unemployment and fiscal policy. Now we will study here also inflation, but the measurements in India, how we measure the inflation in India. So inflation measurement in India, we will talk about that. And then mainstream banking and non-mainstream banking, we will discuss in this, and government financing, equity market, etc. we will discuss into that. Okay, capital market and money market. In the microeconomics we will discuss, let me write it here. In the macroeconomics we will deal with the following topics. Macroeconomics we will deal with the following topic, namely changing economic growth. First we will discuss measurement of GDP, that is gross domestic product, and then we will discuss growth pattern, and then we will discuss GDP equation, investment and saving, then we will discuss fiscal policy. Then few topic that is very important in Indian economy we will discuss, like inclusive growth, food and agriculture sector. We get the food from agriculture, so food and agriculture together. And in this food and agriculture we will discuss like cropping pattern, we will discuss MSP, that is very important issue, MSP, and once food grains distribution, that is PDS, public distribution system, Now agriculture needs fertilizers, so we will study about fertilizers, subsidies, etc. So fertilizers, we will see whatever inputs like fertilizers and other input subsidies also in this topic, other input subsidies, so that agriculture will grow. This is the government has provided the help to the agriculture sector. Then investment, we will link investment that we have studied right here, investment and agriculture growth, these are important topic. Then related to this, of course, we will discuss agriculture produce, how can it be marketed, so agriculture marketing, and then food processing. So these basically these topics we are going to deal with in the Indian economy. So let's begin this with with this monetary policy and yield curve. Monetary policy and yield curve. So what is that? Monetary policy and yield curve. Okay. So as far as this monetary policy is concerned, let me take this topic ahead. Monetary policy, right? Then this monetary policy, we keep on hearing this term monetary policy time and again, but what is it? It is simply controlling the supply of money in economy. So in this we control what in monetary policy? Supply of money in the economy. Supply of money in the economy. Almost every country has a central bank. Every country has a central bank. In case of India, this is RBI, okay, which controls the supply of money in the economy. Now, what is money? What is this money? As far as this money is concerned, you might think of that this is the paper notes in our wallet. Paper notes in our wallets, or whatever bank balance you have. So bank balances. But it is not only these two, means paper notes in our wallet and bank balances. It is bit more. So this is bit more than that. Okay. So we will discuss about these things in detail. Now, in this modern time, how we control this supply of money? So this supply of money in modern times, you can control primarily by controlling the cost of money. So if you want to control supply of money, you have to control cost of money, and this is also called the interest rates. Okay. In this ultra modern times, ridden by one financial crisis after another, and especially since the great financial crisis of 2008, central banks the world over have reverted to printing, extinguishing money, or buying, selling government securities in the open market as a tool to control the money supply. But why is controlling the money supply so important? Okay, so money supply is controlled. This money supply or supply of money is controlled to manage inflation. Right? To manage inflation. Now I will take example for that. Suppose entire economy produces 100 kg of wheat. Only entire economy. Okay. Now suppose the central government supplies rupees 100 in the economy. Central government supplies 100 rupees in the economy. Okay, 100 kg of wheat. Then we can say that 1 kg of wheat. Then we can say that this is related to this. So then we can say that 1 kilo of wheat will cost rupees 1. So 1 rupees per kg of wheat. Now let's say that economy output remains the same. Means this is the economy output. And let's say that economy output is same. So this remains same, but this remains same. Okay, output remains same, but now central bank, what central bank did, increases money supply to rupees 200. Here we write central bank. Okay, so central bank supplies 100 rupees to the economy, and in the economy only 100 kg of wheat has been produced and nothing else. So you can think of the rate of wheat. Then must be 1 rupee per kg of wheat. Now central bank, if supply 200, means it increases from 100 to 200. Then what will happen? This money supply has increased from 100 to 200. Now the wheat price should be rupees 2 per kg of wheat, because we have more money in the economy right now. Output is still 100 kilos, but the total money in the economy has increased to 200. So 1 kilo of wheat will now cost rupees 2. So prices have increased from 1 to 2. So this, if you see this data, the prices have increased from 1 to 2, and increase in price is called the inflation. So from 1 to 2 this price has increased, and you can write it separately. So price has increased from 1 to rupee 2. That means how many percentage has been increased? 100%. So this is 100%. Inflation is 100%. 100% it has increased, and increased in prices, inflation. Now but in reality we are not producing only wheat. Okay, so you see the money supply increased from 100 to 200, and then price rise from 1 rupee to 2 rupee, means inflation. If there is a more money supply in the economy, there will be more inflation. But in real world it is not as simple as this example that I have provided. And that's why so inflation affect common people, because rate has increased. So controlling the money supply is so important. Okay, so primary tool is, if we reduce the money supply, inflation will reduce. So this act as a primary tool to manage inflation. Okay, now the question is, why central bank like RBI should bother about inflation? So question is, why a central bank should bother about inflation. Okay, well, we all know how important it is in our daily lives. Government can fall and entire economy may destabilize if inflation run away. More effects of inflation on the economy will be duly covered in the next discussion, but you must understand here that inflation is so much important issue that due to which government can fall and entire economy may destabilize. Okay, so money supply. Now if you want to control the money supply, the primary if you want to control the inflation, you have to control the money supply. So yes, so if you want to control inflation, you have to control money supply, because money supply increase 100 to 200, then price rise happen, that is inflation. That means you can control this inflation through money supply. Now central banks, how central bank will do it? Okay, so the preferred method for this is by controlling interest rate. By controlling interest rates. So when interest rates are raised, cost of borrowing will increase. Cost of borrowing will also increase, and this led to the less borrowing by the people. So borrowers will borrow less. Borrowers will borrow less. So less money will change hands. So less money will change hands. Unlike say wheat. In the case of wheat, if say 100 kilos are produced by a farmer and he sell it to somebody, then that somebody will sell the other one, okay, or hold to consumers. The total output of the wheat in economy remains the same, means 100 kilos. But when RBI prints 100 rupees and gives it to bank, RBI, suppose RBI is printing money 100 rupees, right? Print 100 rupees and give it to bank, right? And bank will let this 100 rupees, bank will lend to a person, let's say A, this 100 rupees, right, to person A, and person A pays to other person this 100 rupees, to person B. So this is money changing hands. Okay, so if money changes, so total money supply in the economy becomes, so this 100, this 100 and this 100. So total money supply in the economy is, total money supply in economy is rupees 300, while you are producing only 100 kg wheat. This remains the same, but money, you see, money changes hands and its supply increases, right? It will not remain just rupees 100, but it will become 300. Means total money in economy increases to 300, unlike wheat which remains 100 kg wheat, right? Now the implication of increasing interest rates are clear. Once you increase this interest rates, cost of borrowing will increase, so borrowers will borrow less and less money will change hands, so money supply will be less and so inflation will be less. Okay, so I am writing it again. This logical point means when borrowing interest rate increase, interest rate, if RBI increase the interest rate, what will happen? Borrowing cost will increase. This is nothing but the borrowing cost. Borrowing cost will increase and borrowers borrow less. Borrowers borrow less. So less money changes hands. So money supply in the economy will decrease. So inflation will decrease. So this is the whole story. Inflation will decrease. So this is the whole story. Okay. Now one questions, then I will leave this lecture. One question I will discuss that has come into civil service examination. I want to make the several short video to understand the concept, right? So based on this concept only you can solve one question of civil services. This concept. Now I will write it as concept 1. Now when interest rate will increase, borrowing cost will increase. Borrowers will borrow less. That means less money changes hands. That means money supply will decrease. That means inflation will decrease. Now based on this, you can solve problem that has come in civil services exam 2023, right? The question was, consider the following statement. Consider the following statement. In the first statement is, in the post-pandemic recent past, many central banks worldwide has carried out interest rates hike. Means they have increased the interest rates. Many central banks worldwide post-pandemic. Central bank, second statement is, central bank usually assume that they have the ability to counteract the rising consumer prices via monetary policy measure. Now we will check which one is correct. Now see, post-pandemic inflation has increased. In the post-pandemic, inflation has increased. Now to cool off this inflation, what RBI, what central banks worldwide has done, that they have increased the interest rates. And thereby what happens, that borrowing cost has been increased. So cost of borrowing has been increased, and this led to the less borrowing, and this led to the less money changes hands. And this led to the less money supply, and this led to the inflation goes down. So see how the central bank So this statement 1 is correct, means interest rates hikes. So you are able to solve this civil service examination question based on this discussion. So this concept 1 has been used to answer this question. Now one more thing that I want to discuss, that it is enough to control inflation. The money supply is the only primary tool, but I said this is the primary tool by controlling money supply. Means there could be a secondary tool as well. Means sometimes what happens that in real life, if you think of like times of great financial crisis, there are certain limitations because of which interest rates only do not suffice as the primary tool to control the money supply. Like in Great Depression time, Great Depression. So I will tell you some exception to this concept 1. Okay. So concept 1 exceptions to this concept, like Great Depression. Now Great Depression or Great Financial Crisis, Great Financial Crisis, there are certain limitations because of which interest rates do not suffice as the primary tool to control the money supply. The transmission mechanism may be slow. Sometimes what happens, let me explain this. Sometimes what happens that economic condition is so bad during financial crisis. Economic condition is so bad. Let me take into next page. Economic condition is so bad that despite ultra low interest rates, ultra low interest rates, the borrowers may not be willing to borrow. What I said in this discussion, that if interest rates increased, borrowing will be less, money supply will be less. And reverse will happen. If interest rates, you will decrease interest rate, cost of borrowing will decrease, and there will be more borrowing, and there will be more money supply, more money changes hands, then money supply will increase, and then further inflation will increase. Okay. So in bad in the economic crisis time, you have to grow your economy, therefore you need to increase the money supply, and you can increase the money supply only by reducing the interest rates. But what happens that by reducing the interest rates, people will borrow the money, and money will change more hands, so that economic activity will increase. But what happens that in financial crisis times, if you increase even interest rates, you can if you decrease interest rate up to ultra low interest rates, then after people are not willing to borrow. Why? Because economic condition is not good. Okay, economic condition is so bad that borrowers may not be willing to borrow. Okay, the borrowers may not be willing to borrow. Borrowers may not be willing to borrow. Because they know wherever they invest, they will lose the money. So a bank may not borrow from RBI despite ultra low interest rates, because it knows that if it borrow and lends to some person who wants to set up, suppose, an industry, so that person will not be able to repay the loan. So despite low interest rate, the money supply will not increase, it will remain as same. So money supply will not increase. Okay, so in such condition, what central bank will do? Now what central bank is doing, suppose central bank all over world, central bank giving loan to bank and bank giving loan to person, firm, industry. Okay, now bank will not want to borrow because there is a financial crisis, economic conditions are poor. So what will central bank do? They will directly pump the money in the economy. Okay, so they will directly pump the economy, pump the money into the economy, pump the money in the economy. How it happens? By buying government securities, by buying government securities. Okay, so let's say you hold a 2-year government of India bond. Okay, bond is a paper, 2-year maturity period is 2 year. Okay, and its worth is 100 rupees. Now it is just paper, it is not money. Okay, it is a paper which can be exchanged into money, but it is not money. Okay, this is paper. Okay, so when RBI buys government bonds, you sell them to RBI, you sell them to, you have this bond, government's bonds. Now if RBI wants to borrow this, you will sell this bond, to RBI. Now you will get rupees 100. So that is money. So RBI will give you 100 rupees. So that's it, money. But this is paper. Okay. So now this money, where does RBI get this 100 rupees? RBI has to give 100 rupees to purchase this government securities. Now where does RBI get this 100 rupee to pay you? Okay, it simply prints 100 rupees. Okay, so the net result is that the money supply in the economy will go up, because you will have in your hand 100 rupees. Money supply will go up. Okay, this is how central bank control money supply. Okay, so this is the way, either by printing money or by decreasing. So in case of financial crisis, they will print the money and thereby increasing money supply. And if there is not so much financial crisis, then they will control the inflation by increasing interest rate or cost of borrowing, increasing or decreasing. So these are the tools used by central bank of any country. Either they prints the currency, or they will increase or decrease the interest rate and thereby control the inflation. Okay, so through interest rate they control the inflation, and by printing the money. So if they print more money, okay, then they can increase the money supply in the economy. This is the direct pumping. RBI generally avoid this. We will see later this thing. Now this is direct approach, direct pumping of the money in the economy. Whereas interest rate, if they will increase, they may increase or decrease. Now if they will increase or decrease, they will increase the interest rate, money supply will decrease because cost of borrowing will increase. On the other hand, if they will decrease the interest rate, money supply will increase because cost of borrowing will decrease, so borrowers will borrow more. So this way they will control. So this is the tool that is used by so this is, I will write tool 1. So tool 1 and concept 1. So we have studied in this way that what are the tools. Okay, so central bank desires to have control over its monetary policy. Now it would not want its action to be dictated by other central bank. After all, each country is independent, sovereign. Okay, so its central bank would want to follow a monetary policy which serves its national interest the best. Now it would be such a spoil sport if suddenly RBI's action start getting dictated not by what RBI itself thinks but by what US Federal Reserve is doing. So this is what meant by independent monetary policy. So every central bank of every country will have the independent monetary policy. Okay, independent monetary policy. Now based on this you can answer another question of civil services, that is, suppose the question says, this has come in civil services examination 2022. Question says, with reference to Indian economy, consider the following statement. First statement is, if the inflation is too high, I will put 2 arrow upwards, too high, the RBI is likely to buy government securities. RBI is likely to buy government securities. Okay, this is the first statement. Now second statement is, if the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. RBI is likely to sell dollars in the market. Okay, this is the second statement. Third statement is, if interest rates in US or European Union were to fall, interest rate will fall. If it will fall in US or European Union, that is likely to induce RBI to, this led to RBI to buy dollars. RBI to buy dollars. So which of the statement is correct? 1 and 2 or 2 and 3 are 1 and 3 are all are correct. So consider statement 1. Now if you consider statement 1, if inflation is too high, how will RBI try to rein it in? If inflation is too high, well, it will try to bring down the inflation by reducing it money supply. They will reduce the money supply. And how they will reduce the money supply? Because if they reduce the money supply, of course this will reduce the inflation. Okay, so this will cool off the inflation. Okay, so prices will fall down. So if RBI buys government securities from you, okay, if RBI buy government securities from you, that means RBI is pumping money in the economy, so money supply will increase. So that will not decrease the inflation. That will not decrease the. So RBI is not likely to borrow government security. So this statement is incorrect. This statement is incorrect. Okay. So RBI will never go for it by never go for buying securities, because this will increase the money supply. But increased inflation needs money supply to decrease. That's why this statement 1 is wrong, clearly wrong. Okay. So what will happen, that 2 and 3 will be correct. So this way you will understand that you can solve the problem. Okay. So I will end this lecture right here, and we will move to next topic, the yield curve, in the next lecture. Thank you.